Real estate versus U.S. Treasuries. I've seen a lot more people start to bring that up. It's attractive to invest at a 4% Treasury right now. And certainly there's a place for that in your portfolio, but we don't believe that that's actually pushing real estate out of the picture. We're going to do an after-tax return comparison of real estate versus U.S. Treasuries. And let's just assume for a second that you can invest in a Treasury at 4%. Let's say you're a highly taxed individual, you're going to pay a 40% effective tax rate, resulting in a net after-tax rate of return of 2.4%. In our funds, we target an 11 to 15% return. We've outperformed that historically, but let's just say for the sake of discussion, we produced a 12% rate of return. And because of the benefits on the tax side of investing in multifamily real estate, we generally estimated an effective tax rate of 25%, resulting in an after-tax rate of return about 9%. That's about a 6.5% differential on your after-tax rate of return. And that's money that's going into your pocket. Now, on the short term, that's maybe not a huge impact, but on a long-term example, that 6.5% when compounded over a period of time starts to make a really big difference overall. We look at the simple rule of 72 here. It would take you 30 years to double your money on an after-tax rate of return of 2.4% versus only 8 years if you're producing after-tax return of 9%. So what we're referring to this internally is the cost of liquidity, right? If you invested $250,000 over the course of 8 years, you would expect that to grow to about $300,000 at a 2.4% rate of return. On the same $250,000 invested at the 9%, it would grow to $500,000. So the question becomes, is that cost of liquidity worth it to you? The biggest drawback of investing in private real estate is that your money is locked up, whereas in a treasury, you have access to it. And so that's where the cost of liquidity comes into play. Now, the question becomes, can you still generate 12% returns in real estate? And I've kind of been hinting at this the entire presentation here, but we still believe that that's very possible. You have to be disciplined and consistent in your underwriting. You have to make believable and achievable assumptions. It's crazy when you look at the pro formas that are put together on these deals, how minor tweaks in the assumptions can make such a large impact on the forecasted return. So you have to be disciplined and not stretch when it's not necessary. We look at a lot of opportunities. One of the critical differentiators for MLG is that we source deals in two different ways. We're both a direct owner operator. We manage about 35,000 apartment units across the country, but we also are a joint venture equity provider for operators in other markets where we don't have boots on the ground. This dual fold sourcing strategy is critical for us. We review north of 100 deals per month with the intention of buying 1 to maybe 2 of those deals. But instead of stretching for every deal that we see in a given market, we're able to be very selective. We're able to choose from the best of the best. And that helps us to find the best opportunities for our investors. Interest rate volatility. We kind of hit on this, but the Fed has made it clear they have a 2% target inflation rate. At some point, we believe the 10-year Treasury will settle down between 2.25% to 3% when the Fed eventually gets to that 2% rate. The 10-year Treasury has historically been at an 80 to 150 basis point premium over the long-term inflation rate. And that's where we're kind of assuming that we can land at these numbers overall. It creates a really unique opportunity right now in the market. You can buy at a higher cap rate environment if rates just stop moving so quickly, or if they do come down over the course of the next 3 to 5 to 7 years. We think we're going to be able to buy in the high cap rate environment and sell when there's a lower cap rate environment overall in the marketplace.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.